What is depreciation and is it allowable for tax purposes? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. What is depreciation? Well, depreciation is the reduction in value of your asset. So when you buy something new, it's perfect, it's new. However, after you've had it for a year or 2 years or 3 or 10, it's probably not worth necessarily what it was worth originally, especially when we're talking about things like computers or desks or furniture, things like that, which over a period of time they get a bit used, they maybe get a little bit abused, so their value is going to reduce in value. And depreciation is the adjustment we put through a set of accounts each year, taking this into account. There are in essence 3 purposes why we include depreciation. Now the first one is to really show in your account what the true value of your business is. So if we just showed everything, such as a computer, at the value you bought it at, as time goes on, your business is not going to be worth exactly the same over that period of time as it was when you originally purchased it. So by putting this depreciation adjustment in, it's reflecting what the true value of the company is over that period of time. Secondly, depreciation shows as a cost of doing business. So it does show in your company profit and loss account. So it's showing you what is happening from a profits point of view, because there is a cost to having that item and the value is going down. So it's showing what the true profits of the business are based on the fact that you are using these assets to actually deliver your business purpose. And depreciation finally is, from a tax point of view, is not allowable, which we'll go on to in a second, but it just has a reflection to give an idea of where your profits would be for tax purposes as well. So there's a few different reasons why depreciation is an adjustment that we want to be putting through our business accounts. Depreciation is only posted against our fixed assets. So check out the video on what fixed assets are so you have an understanding of what we'll be doing with those assets and how depreciation fits with them. Now, depreciation is on things like you would expect, such as computers, desks, furniture in our property businesses. And the reason we have it there is because we all know that a computer today is not going to be worth the same as it is in 3 years' time. Technology is moving and things are going quickly, so things are becoming old quite quickly. Some things in our business are going to just be allowable straight away, and they're just going to go through our profit and loss. Things like the paper that might go into our printer, that would be allowable straight away within the accounts. Whereas the printer is slightly different. We're hopefully, touch wood, especially with printers, that will last us a number of years and work nice and smoothly. So the paper will be allowable straight away, but the printer is a fixed asset which we will then depreciate over 2-3 years until it's basically defunct. Now the next question it logically seems to lead me to is, what are the options when it comes to depreciation and how do we go about doing that? Now with depreciation, there generally are 2 methods that we can depreciate an asset over. One is known as straight line and the other is known as reducing balance. So let's cover those off and what they are and how that works in our accounts. Before we jump into each of those individually, there's one number that we need to look at before we can dive into what we actually do with our depreciation method. And that's looking at what the lifespan of the asset is. So I've alluded to a computer is probably maybe 3 years, but it might be you intend to use your computer for the next 6 years and then replace it. So your lifespan of that asset would be 6 years. Now other items you may think are things like maybe you've got a company car, which there's another video on company cars, so let's not dwell on that side of things. But if we've got a company car, you may go, I've got a car, I'm going to keep it for 3 years and then I'm going to sell it. So now we have a lifespan of that asset of 3 years, but we will have a value at the end of that life. So let's just put some figures on this. I bought a car for 60,000, I'm going to keep it for 3 years, and in 3 years' time it's going to be worth 50% of the value, so it's going to be worth 30,000 when I sell it. So now within my accounts, my need is to depreciate that asset, that car, from 60,000 to 30,000 over the next 3 years. So the methods that we mentioned were straight line and reducing balance. Now, these have slightly different impacts of how we get down to that end value. You might go, a computer is going to go down to 0 compared to a car, which is probably going to have some sort of value at the end of it. And even things like desks, you might go, well, actually, if I sold it, I'm going to get £10, £20. It's quite immaterial in the grand scheme of things. So there is looking at each individual asset to see how it all fits together. Now, the straight line method is quite straightforward, hopefully, because it's just straight line. So with that car that we were talking about, where we had 60,000 and 30,000 and over 3 years, straight line approach would literally go, we've got 30,000 that we need to depreciate it by over 3 years. On a straight line basis, we will depreciate by 10,000 per year. Simple. I do like a simple approach. So on that basis, a computer that we maybe bought for £1,000 that we're going to depreciate over 3 years is going to be £333.33 each year over the 3-year period to get us down to a 0 valuation. So hopefully you can see with the straight line method how you would go about doing that side of things. The other method of how we can depreciate items is the reducing balance method. Now this is slightly different because this basically will take a larger proportion at the beginning of an asset's life and a smaller at the end of the life. So we would pick a percentage rate, so let's go with 50% for a computer, and each year we would reduce the value of it by 50%. So if we start with our £1,000, I'll see how far down the maths I can do this on mental arithmetic. We've got £1,000 at the start, and when we depreciate it in the first year, we've got a 50% depreciation rate, and on that basis we can now go 50% of 1,000 is 500, so we now have 500 we're depreciating it by, and the value of that computer is now 500. In year 2, we are now going to depreciate by 50%, and 50% of 500 is 250. So now I've got an asset that I've depreciated by 250, and I now have an asset worth 250 left. Year 3, we now go, my asset is worth 250, I'm going to depreciate that by 50%, which is £125. So I've now got depreciation of £125, and my asset is now worth £125. I'm not going to continue because the mental arithmetic is too much for this video, but as you can see, you would keep going down each time, 50% each year, until you got to 0. So rather than it being 3 years, it's a longer period of time. But by that point, the value's got to a pretty significant value because we're now going down less than 125. We're going smaller and smaller and smaller. So at a certain point, you kind of go, well, you'll just write off that asset because it's probably not worth anything at that point in time. But hopefully you can see that one is very straight and it goes down to 0. The other takes a bit longer to get to the same point, and it has a slightly different impact on your accounts. Obviously, in the first year, you're probably doing more on the reducing balance method than you are on the straight line method. But then in later years, you're doing more on the straight line method than you are on the reducing balance method. So there is pros and cons to both. I tend to probably say the reducing balance is more realistic in terms of what an asset is actually worth. But then the straight line method can be quite a nice method for things like the car that we mentioned. It might work nicely because you know what your end value is roughly going to be, and it gets it there effectively. Now the final point to cover today is depreciation allowable for tax? And that's a very simple answer. No, it is not. However, for tax purposes, there's something called capital allowances, which is very similar to how depreciation works. But there are a few quirks to it. So check out the separate video which we've done on capital allowances, which explains the tax side of things. Depreciation is what goes into your accounts, and capital allowances is what goes into your tax calculation and where you get your tax relief from. So check out the separate video to see how you get your tax relief. Now we've got your accounts right. The depreciation policy you choose to use will be shown in your accounts within the accounting policies notes after your accounts. and this will just show what rates you're using on your different asset classes. Therefore, this is a topic you'll just need to have a word with your accountant as you're setting up and getting new assets in to make sure you're happy with how things are approached and that they're being disclosed and declared in the right way. Hopefully today you've discovered all about depreciation. What is it? How it works? What are the implications for tax? And what options you have available. If you do have any questions, please do leave a comment. Please like this video and please do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.